Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I ask that you hit the like or the subscribe button on whatever platform you happen to be using. Well, the markets continue to climb higher, even though some indicators say there's some trouble coming up. We'll talk about that. Also, how do you choose which stocks to buy in a bull market like this? And a lively discussion on the administration and the Fed, and also should corporations go from quarterly reports to semi-annual reports? It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies, Frank Rossetti of HF Management Company. Also sitting at the table is Kim Forrest of Boca Capital Partners, and there's one more spot at the table that's occupied by none other than Michael Godwin, the Chief Investment Officer for Gasso Financial Advisors. Thank you all again for joining us for The Bull, the Bear, and You. You know, investors liked it before it happened, and they liked it after it happened. The Fed lowered its key interest rate last week, and the market surged higher, setting new all-time closing highs for the Dow, the NASDAQ, the S&P 500, and the Russell 2000. Now, this was a headline, though, over the weekend in the Wall Street Journal. U.S. investors are flush with cash and happy to keep it there. Money market funds hit another record with $7.7 trillion in assets. So my question is this: if huge amounts of money are sitting on the sidelines in money market funds, what is pushing the markets higher like this?
Well, I mean, I can start. I'm sure Kim's kind of bursting at the seams to answer that question. I think there's a lot of liquidity out there. I mean, that's one thing, right? I've been dying to tell you all this because this is how my mind works, but I was shopping over the weekend and I was at Ross Park Mall. I could not find a parking spot. Wow. So, you know, the great Peter Lynch wrote a book of his many decades ago that said, pay attention to what's happening around you. So, you know, I know that we all like to have our theories about what's going on, but at the end of the day, it's really boots on the ground. So I think there's a lot of liquidity out there. And that factors as money goes into the market, but even just trading of money that's already in the market. And because you have lower yields, you know, it goes back to, and Kim can talk more about this, the discounted earnings that, you know, companies become a bit more valuable. And then lower interest rates also helps to support those growthier type names. So I think there are a lot of reasons. They're not mutually exclusive, that, you know, money flows into money markets would take away from the stock market or not support the stock market.
Being the gentleman that I am, let me jump in before Kim, because she's smarter than I am, and she'll take all the stuff that I had to say. She'll say it first. Two things I could point out here maybe. One is, just because a stock goes higher or the market goes higher doesn't mean people have put money into that stock. Take Oracle from, a week or so ago. Oracle jumped by 40%. That's not because people put a ton of money into Oracle. Oracle just had blowout earnings and their stock price just got revalued higher, which drove the markets higher. So it's not necessarily more money going into the markets that did that. The second thing is, money markets have been going up since the early 1980s. There's been really two periods where money markets have declined in the amount of money in there, and that was just after the dot-com bubble and just after the global financial crisis. Since then, even though we've had a strong bull market for the past decade, the amount of money in money market funds has continued to go up. And as Carrie pointed out, there's just a ton of liquidity in the systems here. So to Carrie's point, I don't think they're just mutually exclusive. They can operate at the same, you know, they can operate in cohesion with one another there. So, I think that's part of the reason why the markets continue to go up. Earnings look pretty good, and valuations or prices of companies continue to get reset higher, even though people are throwing money into the money market accounts. Thank you, Kim.
Go ahead, Kim. I trust that I'll say something different than has been said.
Okay. Well,
You know, Michael, I'm not that smart. I'm just bold enough to say what's obvious. That is, you know, that is my charm, is I am queen of the obvious. And you eclipsed me, you got there before me, that the last price that a stock is traded at is how the company gets valued. As crazy as that as that might be, that's the function of the markets, is to reprice. So why are things going up? Well, I think Carrie has an interesting point of view. I have not been to Ross Park Mall in a while, but now I'm going to have to go there. Thanks, Carrie. But today, the Chicago Fed National Activity Index, which is a leading, a special combination of leading indicators, has shown that in August it looks like the economy is expanding. And this is against everybody talking down all of the problems that are so obvious. So I guess maybe being smart is you pick the more important parts that are obvious to talk about, which is, hey, maybe the economy isn't quite as bad. Another structural thing that could drive markets, or that tends to drive markets, has nothing to do with money market going from the money market into the economy, is the fact that we all have a 401k that is automatically put into the market for us. While that's really good, it has that effect of not having people actually choose to put money in the market. So the markets can grind higher even on no news, because that last price that a stock was bought at is what the company is valued at. So there you go. Okay, hand it off to you, Frank.
Okay, so as far as money market funds go, I've said this before and I'll say it again. Banks, Mike, to your point, have been paying pitifully low interest rates for years. I haven't looked at bank deposits lately, but I would suspect the bank deposits are not growing, maybe even shrinking. If anybody's looked at it, let me know. And I think the money is moving to money market funds because you can get in the neighborhood of 4% plus in a money market fund for now. And I think that that's money that isn't necessarily intended for the stock market, but it is intended for getting better interest rates. And I think that's one of the reasons. And additionally, the stock market is valued, according to the Wilshire 5000, somewhere around $66 trillion. And the money market funds at 7.7 trillion means that the money markets are about 14%. What is it? How's my math there? Close enough. 13, 14% is in cash, which if you look at most money managers, they're going to have 5 to 10% in cash just in case something good shows up, and just to have some free liquidity. So if you put those two pieces together, I'm not sure money market funds are that out of line.
Okay, I've got a question for almost every one of you here. I'm going to start with you, Michael. You said that the I can't give you a quote, unfortunately, but my question is, how does the price of the stock go up if it's not being bought?
Kim, I could do it, but Kim can. She's so much smarter than I am, Stacy.
Oh,
She gets so much more
geez, you're putting so much pressure on me.
Who knocked you off your horse, Mike?
I'm coming at you with a jousting stick, Michael. Okay, now I'm teasing. Okay, so the math is this. A company has so many outstanding shares. And maybe you bought Oracle in like 1996 and you're still holding on to it. You haven't added money to the market. That value of that stock has increased, and the value of the company increases because the math of how we do assessing a public company, what the value of the company, or how much market capitalization it has, is the last trade at the close sets the price. So you multiply that times the number of outstanding shares, and voila, the value of the company. But all of those shares, even though you bought them at far lower prices, are now valued at that last price, because that is what a market is. Supply, demand, whatever that price is applied to the company. I hope that makes sense.
So basically, if I got this right, then somebody sold some Oracle and the price was higher when they bought it, so that boosted the price of the, or at least sustained the price of the closing for that day, I guess. I don't know.
Sure, yeah, I mean, whatever price. And it works the other way. That's how you lose money in paper markets. Even though you bought Oracle at $300 and it's now at $299, you lost some money, theoretically. We don't think you lose money until you actually sell, but that's a different concept.
Yeah.
All right. Now, you, Kim, said something about the Chicago something or other as a leading indicator.
Yes.
The U.S. leading indicators, the leading economic index fell 0.5% in August, and so according to the Conference Board. So that seems to be in contradiction to what the Chicago people said.
Right. Well, the Chicago people are looking at some number of, and it's their private formula, some number of leading indicators for the month of August, and they apply weights to them. So what does that mean? Some factors are more important than others, right? And that's how they come up with their number. I don't really look at that number. I look at the 3-month moving average, and that's up. So anytime it's above negative 0.7 for 3 months or more, the 3-month average, that shows an expanding economy. Why is it -7? It's the way that it's set up. Now we're into the weeds of how
Right.
the math goes for that thing. But they've done a lot of work, and it's one of those things that are not really published or not really looked at widely on Wall Street. And I'm mystified as why, because it can forecast recessions like 6 to 3 months before they happen. So it's kind of an important thing to watch.
Interesting. Very interesting. All right. Carrie, my question to you is you said you went to the Ross Park Mall, which is a mall in the Pittsburgh area, and you said you couldn't find a parking space. This seems to be then in contradiction to the surveys of consumer confidence and this sort of thing that's going on, and all the fears that people are going to stop shopping because of tariffs and increased prices for items. So what do you think's happening here?
I was just as surprised as everyone else. I'm like, what is happening? It seemed like Christmas, like where you have to kind of circle a couple times. And, the weather was nice. It wasn't like it was even rainy. So, this goes back to every number that we get in some way, shape, or form is either a look in the rearview mirror or an estimate of the future. It's not real time. So, yeah, I mean, it's interesting. We did get a retail sales number out recently that was higher than expected. I don't know, maybe this is a trend. And people, when they're surveyed about their confidence level, like whoever feels confident, like no one's ever confident. Everyone's always like, oh, there's so many things to worry about, and there are, but that doesn't necessarily mean we're changing our behavior all the time.
I think it's some of those surveys too. People are thinking like broadly, oh, the economy's not very good. We're slowing down here, but I'm fine. The jobs, I still have a job. I'm doing okay. And a lot of people kind of feel like that, where their situation's okay, but they think broadly and broadly economically that things are getting worse and worse. But the fact of the matter is, unemployment has ticked up a little bit to like 4.2%, but a lot of people still have jobs. A lot of people are still working. The economy's not as bad as maybe these surveys say, or maybe we're reading about in the news for the most part. I don't think. I mean, earnings came. I mean, we finished earnings season 3 weeks ago, Kim, a month ago or so.
Yeah.
In aggregate, not bad, pretty good.
And
Yeah,
guidance,
all right.
not bad, pretty good.
Right.
Much better than expected. Much better than expected.
Well, so my next question is this: is in a bull market such as this one, is it easier or more difficult to find stocks to invest in?
I quickly say, before Kim starts, it's always difficult to find good investments. Not
Frank,
just-
I love that answer. I love that answer. because it's true. You know, I've been doing this, next year will be 40 years. There has never been in 40 years a day that I woke up and said, that's it, put it all in. I mean, there's always something, there's always a fear. It's either too high or it's going down and it's going to keep going down. So, you know, I think that depending on what you're investing in, there will be things that are, it's hard to find some good quality or some good valuations in certain circumstances. However, if you're a growth investor, like that's just part of the game. But there are also times where you do have growth taking off and those value stocks have kind of been left behind, and that can present a good opportunity when people get really over enthusiastic about the growth sector. So, you know, Frank I love that answer.
Okay.
And there are multiple ways. There are multiple ways to make money in this business too, right? Some people like to pick individual stocks and do that. Others, maybe such as myself, we like to look at whether it's factor investing, sector investing, asset class investing, making tilts one way or the other based on your economic outlook. You can do that as well. You know, some of us do alternative investing, some don't. So there's a multiple ways to take advantage of whether it's the bull market that we're in or the economic environment that we're in, and you can go about your business doing that. And I think that's the beauty of the investment world that we're in.
I think that's a beautiful segue for me here. You have to figure out what your game is, right? It could be you know how to pick ETFs, or you know how to shift sectors. That is a useful thing to do when you're trying to make money. A lot of people love momentum. They're going to hop on board whenever it gets to be a certain volatility, right? How much the price is going up or whatever. Okay. For me, I look at companies I'm a fundamental analyst, and I believe every single day there are companies that are on sale because they're not understood. And why aren't they understood? Because their financials don't meet their potential. So I can look at a company's finances, look at their history, see who the managers are, see what their track record is, and go, aha, a hidden gem. So I agree it's hard, but I don't know. I love doing hard things. So I've picked something kind of hard to do. But I do think in every market, there are things that are unloved, misunderstood. And if you're a patient investor, you're going to get rewarded.
Keyword, patient.
Yeah. I saw this morning that gold reached another new high. I guess I was wrong in this belief that gold was always something that people ran to when they thought things weren't going well. So it's going up. The markets continue to go up. Is it just one of those strange kind of things, or is my previous belief wrong?
Briefly, gold moves for basically two reasons. One is inflation concerns. The other one is geopolitical concerns. Today we have huge geopolitical concerns. I would suspect there's a lot of international money that is flowing to gold because it's transportable. Things are changing in the world very rapidly, very chaotically, very difficult to predict what's going to happen next. And I would suspect there's a lot of moneyed people out there who are hoarding gold simply because if they get thrown out of their country or whatever, they have a stash to take with them to wherever they land. And I've got a hunch that's a big part of what's going on.
So it is a hedge then still.
It's a hedge, yeah, for living in some cases.
And concerns around the U.S. debt probably don't help either, Frank.
Yes.
Okay. Well, you know, those who like to put money into the futures market, making a bet, basically, a lot of them are betting that interest rates this year will drop more than the Fed's forecast. Now, if the bet is correct, will that finally bring down the yield on the 10-year and then eventually on mortgage rates?
That is I could talk about that for 2 hours. One of my
You have about 10 minutes or so.
right. No, I won't take it all. I'll take one. You guys know this from past interest rate talks. One of my biggest pet peeves are all of this. Like, we're anticipating 7 rate cuts, and we all know how that plays out. Like, you do have to follow the data, and until you have the data, you don't really know. So I think that people who say that are getting well ahead of themselves. We have a situation right now where, I mean, in my opinion, I'd be curious to hear everyone else's, probably the biggest concern is still stagflation in terms of, if we do have inflation that still remains sticky and maybe even goes up, and the labor markets, they're slowly deteriorating. That's not a good situation. So it really depends, because the longer term interest rates, the 10-year mortgage rates, are really a reflection of a few things. But one thing is the future of the economy. So you can interpret those yields remaining where they are as being a sign that the economy is actually more solid than what people think. So
When you look at the employment numbers, which are driving this recent change in approach, I wonder, and I don't have an answer for this, but I have a curiosity about it, and it'll hopefully play out in the next few months. I wonder if the employment market really is not as bad as it looks. The number of employees is shrinking and making it a little difficult for corporations to hire. And maybe we're getting back to the pre-pandemic times where there were, I don't remember the numbers, so I'll make them up, 6 million people not working and 6 million jobs available. But the people who weren't working didn't know how to do the jobs that were available, and there was a training issue. And maybe we're getting back to where we were prior to the pandemic, and that's the problem. There's workers, but they don't know how to do the work that's available, or want to do the work that's available. And this is just a thought of mine. We'll see how it plays out. I'm not smart as Kim, so I can't figure out whether it's going to be the way it is.
That's an interesting thought, though, Frank. I haven't thought about that before. I'll have to think about that off air too. But I think it was interesting to see, Frank, back to your question on mortgages and all that. But when the Fed cut last week, we saw the 10-year and the 30-year go up, right?
I suggested that a couple of weeks ago that might happen.
Yeah, I mean, there's
an inflation issue.
Right. The market's still worried about an inflation issue, and not super worried yet about maybe a quick drawdown in the economy or a big slowdown in the economy or a recessionary environment. So it'll be very interesting to see what happens in the latter couple parts of the months of the year. With I think it's baked in that the Fed will cut again in October. They essentially signaled 2 more rate cuts this year. But is it going to? The 10-year doesn't move. That's not going to help housing prices or mortgage rates. And even if the mortgage rates came down 25 or 50 basis points, that doesn't really help first-time home buyers when the home values have gone up 50% since COVID. So there's a lot of issues regarding the housing market that, boy, we could talk about for hours on end.
Cost is the biggest problem they have.
Yeah, 100%.
So I'll be cleanup batter here. You know what we haven't talked about at all, refreshingly, in the last 20-some minutes that we've been talking? AI. Thank God. But I'm going to bring it up
But
here.
you had to bring it up, didn't you?
I did. Well, and then, because everybody's like, ooh, Kim's smart. I'm going to use some vocabulary words here. So part of the problem with measuring inflation is they don't do timely, I believe it's called hedonic adjustments. And what that means is there are products in the basket that they look at that were never in the basket before, right? Or actually, let's put it this way. How the BLS does is they go out and actually have an army of people asking how much something costs every month. Years ago in the Wall Street Journal, there was this hilarious piece that this person had to go to pet shops and ask how much parakeets were. It just burned into my brain. It's kind of fun to do, but a ridiculous thing. Anyhow, so the basket of products that we use is not the same this year as last year, and certainly 10, 20 years ago. Very different world. So there's some thought that inflation is always overstated. I know, I fill up my gas, I eat food, inflation's real, but for the kind of products that we can get, if we looked at them 10 years ago where they were, not really ready for market and we bought them, it would be impossibly expensive. So there's that thing. I just wanted to roll that out for you to think about. I believe that the inflation curve, or the interest rate is, holding the economy back at a certain point, and it surely shows up in housing. There's a demand for housing. People don't want to pull the trigger because they don't think the value's there. Renting looks a little bit cheaper than owning a home right now. Probably always is, but we do it anyhow. We like to own homes here in America. But that's holding it back. And I think this administration's going to do whatever it can do to try to drive housing, because that'll drive employment and all that kind of good stuff. Anyhow, and I agree completely with Carrie that the future is impossible to predict, and all of this, we have 7 rate cuts now on the board. Just ignore all of it. Just say to yourself, do you think inflation rates are going higher or lower? I think right now it's lower or treading water. And then live your life accordingly. And that's your investing life as well as your, regular spending life. That's it.
That's it?
That's it. That's all I got.
All right, we only have a couple of minutes left here, and I'll throw this one out, and many of you may not want to comment. Frank probably will, but I don't know if anybody else will. The pressure from the White House on the Fed, wanting to fire one Fed governor, moving somebody from his own White House, I'm not going to call it cabinet because it's not cabinet, but a list of advisors as a Fed governor. The pressure he's been putting on the Fed chairman for the last, since January, or maybe even before that when he was campaigning. Will this, I guess maybe the real question is this going to have much of an effect at all, do you think, on the Fed long term?
It probably won't. I don't think any of us here like it. I hate the fact that it's become somewhat politicized, somewhat that we're talking about. We should never be talking about the intermarriage between these two. So I hate that. I don't think it's going to have a longer term impact for the most part. The president can pick who he wants to be the Fed chair, depending on when you get elected. But Trump has that capability coming up. So, but I hate the fact that it's become this narrative in the markets.
Just to point it out, that Mike, to add to what you're saying, Trump appointed Powell.
Right.
And now he's public enemy number 1 to Trump.
And Frank, you bring up a good point. And the reason why is because the administration feels that that rates need to come down in order to, secure the economy. The scary part about it is that if you have someone in there that is, going to go with the flow in terms of what the administration wants, markets are free, right? And the biggest concern about lowering rates too aggressively is that it's inflationary. So, the unintended consequences of the statements that are coming out of the administration, they're just not being followed through. I don't know whether they're being said because the administration truly doesn't understand economics, or is it just kind of the popular thing to say because, consumers, us all, we love the idea of interest rates going down if you take away the negative impact it can have on prices. So, yeah, there's a reason why the Fed should be independent.
I'll tell you what I do love, though, change the subject there, is the Trump bringing up the fact that we might wants to go from quarterly earnings reports to semi-annual.
I was going to bring that up. Do you
That
like that?
I love that.
Yes.
Kim hates it. I love it.
I hate it.
I love it.
If
I
you
would do
can't
annual
control
instead
yourself
of
as an
semi. Do it
investor,
annually.
shame on you.
I love it.
You know, I've run a number of businesses in my life. I was raised by an accountant, and I wouldn't be able to run my businesses if I didn't have a command of the numbers. And every now and then, some outside party has to, like the controller or the comptroller or whatever you want to call that person, has to come in and verify that what the bookkeepers have been doing is actually right, because I'm running on what the bookkeepers do. And every once in a while, I need that check and balance. And the bigger the entity, the more important that becomes because the more unwieldy the whole thing is. The little businesses I run were easy. These big monster companies are difficult. So I'm not sure I agree with 6 months. We'll survive.
You need to do that every
We'll
3
make
months.
people like
I don't
Kim
know.
busier.
Well, here's the thing, and this could be a topic for another day, but that all makes sense. But then when you factor in executive compensation, right? Because these executives are getting paid based on earnings and stock price and everything else. So, for us rational people who run businesses, we know that when we make an investment that yes, earnings might go down, but we understand how it's going to play out. A lot of investors, they're only looking at the numbers, and the CEOs are so concerned about what they're showing in their quarterly numbers so that the stock price won't get slammed.
And I just don't think limiting information is the way to go. These companies are owned by shareholders. Now, if they're short-term shareholders, short-term focused shareholders, I don't know, but I think most people are longer term just because they don't have the luxury of sitting there going buy, 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 sell, sell, sell. So, and I agree, Carrie, people, the executives have to make decisions and say, we're going to take a loss because we're buying this company and it's going to make us better. We're going to lose money for the next year, but after that, we're going to, show increased profits. And if the shareholders only look at the numbers and sell, 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 well, they weren't real shareholders that you were working for anyhow. So I think this is solving a problem that wasn't a problem, to be honest. Europe works like this. They have 6-month reporting periods, and because if they're listed in the US, they have to do quarterly. So it's not much of a change for them, but I don't think less information is ever the answer.
Just to close that up, 110 or 20 years ago, a journalist named Ernest Benn in England wrote some words that Winston Churchill gets credit for saying, among others. Those words were, politics is the art of looking for trouble, whether it exists or not, finding it everywhere, misdiagnosing it, and then applying the wrong remedies. Now that was 110, 20 years ago. Still true.
Michael, it looks like it's 3 against 1 here. You have anything to say?
Yeah, you're all wrong. All wrong. It's much better to do it less frequently. The companies will save a ton of money. They can focus on their business instead of focusing on getting ready for a quarterly earnings report. If you're long-term shareholders, you shouldn't care what happens over a 3-month period. You're all wrong. I quit the show.
I sure hope not. All right, but we do have to end the program today.
Michael got back on his horse.
Yep, he did. Yep. We'll continue our look at investing and the economy in future editions. And since you're watching or listening to this podcast on whatever platform you happen to be using, I ask that you hit the like or the subscribe button. But for right now, thanks again for joining us. We'll see you again in about 2 weeks for the bull, the bear, and you.